Hello and welcome to Your Business, Your Wealth. I'm Cory Shepard, president of Sound Financial Group and co-host of this show with Paul. I have a whole armory in my beard, Adams. Uh, second up or runner up for that was Paul. Just like Chuck Norris, I only have a beard underneath my beard, Adams. So sorry, I couldn't do just one. In case you're just jumping in, we're in part 2 of a series called Illusions of Investing. And they're set up so that you can just keep listening right here if you're just jumping in. No need to stop. But once you're done, definitely go back and start from the beginning because there's some great content there. And we're really recapping a series of conversations that Paul and I had when we first met, where he helped me uncover some things about what I was doing for my family and then by proxy for my clients that weren't quite leaving us in the best place possible. So it was the best strategy ever for getting me to join him in our long-term relationship now, because it quickly became a moral imperative for me to not be doing what I was doing in the way I was doing it, and to join forces with Paul and get this message of academic investing scholarship out to the world. So with that, I'll turn it over to Paul for part 2 of Illusions of Investing.
So in our last episode, we covered the idea that active managers, there's zero academic evidence that they can consistently or predictably outperform what the market was going to do anyway. Now, that in and of itself, if you're just tuning into this episode, you will want to go back and listen because there's a significant amount of research around that we pulled apart in that last episode. But one of the things that people do all the time is that once they've been exposed to that, they say, yeah, Paul, I get it. The average asset manager doesn't do a great job. But I don't choose the average asset manager. The asset managers I choose, they are the ones who have performed above average over time. And me and my existing advisor only pick those fund managers. And that leads us to illusion number 2, which is track record investing. That's the use of performance history from some asset manager to best determine what their future performance is going to be. The illusion is that if we find funds that did well in the past, that's going to be a reliable indicator of them being able to do so in the future. And that would seem to make sense. In our world of pattern recognition, the fact that our ancestors figured out when the buffalo were moving through the area, or when the migration of the birds would occur, or what would cause crops to grow, we are wired with pattern recognition. And you would think that that pattern recognition would pay off in the performance of an asset manager. It pays off when you hire an employee. If an employee did well at their last role, it only seems to make sense they would obviously do well at their next role because they have what? They have performance history. And then we blanket lay that on top of asset managers attempting to speculate and perhaps even gamble in the market with your money as they attempt to beat the market, which so often doesn't occur. And let's look at some actual data. So for those of you just listening, I'm going to do my best to cover this in a way that continues to be entertaining and engaging, despite the fact that you don't see some of the data that's on my screen. And you can always go back to YouTube and catch the actual graphics later. But I'll do my best to pull it apart for you, make it easy for those of you listening to the podcast. So here's what we're looking at. We took the top 30 equity funds, meaning stock-based mutual funds, that had the best rate of return from 1998 through 2007. And those top 30 stock-based mutual funds did 17.2%. Now, keep in mind, these top performing mutual fund managers are compensated incredibly well. They are considered the best of the best at what they do, compensated millions and millions of dollars to be the best at what they do. And we're going to see how they shaped up. Well, if we compared them to all stock-based mutual funds that were invested in U.S. equities, it was 6.92, and the Standard & Poor's 500 over that 10 years, 1998 through 2007, did 7.23 versus 17.2. So these folks outstripped the S&P 500 by over 10%, more than doubling the rate of return of the Standard & Poor's 500. And you would think, man, that is pretty impressive. Now, the funds that survived that 10-year window of time was 2,718. Now, before I show you what these equity managers did, these stock-based mutual fund managers did in the next 10 years, let's pause here for a moment and reflect. Why do people choose these asset managers with better track records? Is they think that the idea rests on the reason they outperformed the Standard & Poor's 500 by nearly double was because of some unique view on the market, proprietary trading, something they knew that somebody else didn't know. And as a result, that caused their outperformance. That's why people tend to chase returns into those asset managers that did well in the past. But let's look at what they actually did in the following 10 years. Now, the following 10 years is a very different 10 years. We have the mortgage crisis in the following 10 years. But the key is this. We're going to look at how these managers did compared to the Standard & Poor's 500 index. Because if they did know something unique, it's not just a matter of them outperforming all the average mutual funds, but also they should have been able to stay ahead of the S&P 500. Now, during this window, those top 30 asset managers did 5.4%, while the S&P 500 by itself, no help, no asset manager, did 10.39%. So let me say that a little bit differently. The same asset managers that overperformed over double in the prior decade, the S&P 500's return, now are nearly half of the S&P 500's return for the following decade. And they also underperformed the average U.S. equity mutual fund that survived through that window, which now, because more funds have been added since 1998, is now over 4,600 mutual funds for the remaining study years. Now, here's what some people could say is, well, Paul, that's a 10-year period, and that 10 years is very different than the next 10 years. So why don't we just take the same decade in 5-year increments? Okay? Same decade, 5-year increments. In the second half, top 30 asset managers, including 2008 and the mortgage crisis, did 6.28%, while the S&P 500 managed to get 4.5%. While all the average of all U.S. equity mutual funds did 1.32. Once again, stellar performance by the top 30. They outperformed the S&P 500 index, and they crushed the performance of the average U.S. equity fund. Now, from 2012 through the remaining period, 2017, was fairly good times in the market. Let's see how our top 30 asset managers did. Well, from 2013 to 2017, they once again repeated performance, not too dissimilar from our last study, of 4.99%. Well, then you might ask, Paul, what did the S&P 500 do over that period of time? 16.25. Meaning the S&P 500 returned nearly 4 times what the best asset manager for the prior decade had done. These top 30 managers got crushed in returns. And the average U.S. equity fund, if you had just covered your eyes up and blindly selected the average U.S. equity fund, you would have done 12.8%. This is a huge differential. And what it starts to prove is that these asset managers that did well in the past tend not to do well in the future. I'm going to give you one more look at this. This one's much more visual, and I'll do my best to make it simple for those of you just listening to the podcast. But we have the top 25% of all equity mutual funds, meaning we did back testing all the way back to 2004. We get this out of the University of Chicago and their work along with Dimensional Fund Advisors. 2004 through 2008, if you just took the top 25% of performers for that 5-year period, 2004 through 2008, only 28% outperformed the index over the following 5 years. And that's after we took only the top 25%. But you can see as you look down the list, in all of these little 5-year windows where we took from the prior 5 years the top performers and then tested them over the next 5 years, what you see is that on average, only 21% outperformed the market. And that was after taking only the top 25%. So what we start to see is that even if we have really great track record investing from some of these asset managers, we have zero correlation with their ability to outperform in the future. This is a big, big deal, and not something that the mutual fund companies ever go around and market. And why would they? Because then you'd have to go in, look at their track record, and necessarily go, hey, what mutual funds did you drop off the back of the bus like we talked about in the last episode? And by the way, that's all stock-based mutual funds. If we did the same thing with bond-based mutual funds, we don't get that different of a result. Even if we take just the top 25% of them, only 28% outperform the market in the following 5 years, even after taking the top 25% to start with. Meaning, taking the upper echelon in performance for the last 5 or 10 years is not likely to be able to be a repeat performance in the subsequent years. And I know that can be a little bit shocking, and we're going to talk about in a minute the randomness of that and a unique thing that we've done when we're either invited in to speak for a group of people, or when we do one of our events and we illustrate to people how random this asset management game is. And we're going to come back with that right after this message from Sound Financial Group. Hey everybody, I'm interrupting our show for a really important reason. We have a brand new white paper we're hoping you'll get value out of. Some of you actually might not even need the white paper. You might be ready to talk with Cory or I or our other team members about our philosophy. We'd be honored to do that with you, and it's in your control as to whether or not after that you would want to apply to become a client. We just want to impart more knowledge to you and make you better equipped to deal with the financial institutions and every offer that comes at you. But in the meanwhile, we also have this white paper that we want to give you, get in your hands to help be able to shift the way that you think about money. This white paper is going to show you 3 of the biggest mistakes we see people make and 6 ways to fix those mistakes to get you and your family on the most efficient track toward financial independence possible. You can get that by emailing us at info@sfgwa.com. That's info@sfgwa.com. And we'll look forward to hearing from you soon. We'll get it right out to you. We hope you read it. We hope it opens up your mind and puts you in a position to better be able to design and build a good life. Now back to our show. Welcome back. Now you may wonder, if you're watching this on YouTube, why there is a big coin in the middle of your screen. And it's because I'm going to walk you through an exercise that we do inside of live events where we've either been brought in to speak to a group or we've done one of our own client events to illustrate the point of the randomness of returns, even with super competent asset managers. So I want you to picture a big ballroom, and we tell the audience that in the middle of their table, usually hidden underneath the flower arrangement or something like that, we have placed a bunch of dollar coins. Yes, they still make them. So we put those dollar coins out on every single table. And then we begin having clients compete as asset managers. Like you may notice that there's almost never an asset management firm that markets a new mutual fund that has 0 performance history. And you may wonder why that is. Well, it's in part because the major mutual fund complexes will take new asset managers, give them several million to manage, and by managing that several $1,000,000, they're given the opportunity to beat the benchmark index with this relatively small amount of money. And they line them up against other newly minted CFAs and MBAs, and then they say, can you beat the market? If you can't, no big deal, but you will lose your job and the assets inside your fund are going to go to somebody else. And so by the time 3 years rolls around, that asset manager has a bunch of money under management. And despite these being fully filed and running mutual funds, they just haven't been marketed yet, which makes the disappearance of their returns, as we talked about in the last episode, that much easier. Now, we have everybody stand up. And we let them know that if you flip heads on your coin, you have beat the index that year, which, by the way, is not that different of the actual likelihood for an active asset manager to beat the index they're being compared to. So we have them flip. And sure enough, half the room will get tails on average, and half the room will get heads. If they got tails, they need to sit down and hand their coin to somebody who did beat the index. And then we move on to year 2. Now about half the room is standing and they flip again. And about half that group gets heads and half the room gets tails. And the people that get tails have to hand their money to whoever's closest to them who's still standing, who's a quote unquote successful asset manager. And we go again, and you kind of picture in your head a room with 100 to 500 people slowly winnowing down. And as the room winnows down, the asset managers that are still around now have more and more money under management. By the time we get to the end of our third turn, or in this case, our third year of performance, we kind of highlight some of the asset managers in the room and what a good job they're doing. And they're going to be interviewed on Forbes and Money Magazine and Inc. And they're going to be out in front of everybody with their expertise. Now, if I'm having some fun, I'll even hand a microphone to a member or two of the audience and say, would you please share what your technique is and the way you're flipping the coin? And if you get people really competitive, they will even, a random event like coin flipping, they will begin to invent narrative about how they're doing what they're doing to game or theorize their strategy for flipping a coin. Now, we all know as we witness this and we talk about it on this podcast that it's like, that's just ridiculous, Paul. Except what we all do is invent explanations. And by inventing explanations, that's our rational side. We have this irrational behavior we can sometimes be in, but then we invent explanations for why we're in the maybe irrational behavior. And that becomes rationalization. I've heard it said before that we're emotional creatures that rationalize our decisions, not rational creatures with emotions. So now as people are flipping their coins, the stakes are getting a little higher. You know, if there's 100 people in the room, there's $100 at stake, and those personalities come out in the room that are competing for this prize of being able to take home all the coins. Not too different than the asset managers compete. But now they're out in the open marketplace, and we watch fund after fund get closed as people have to sit down. Now, our record for this was a woman about 67 years old who flipped the coin a total of 16 times in a row heads. And everybody's cheering and having a blast. And of course, she's got this big pile of coins in front of her. And just for fun, she had already had everybody else sit down by the end of 9 flips. But then we had her keep going to see what would happen. And we got 16 heads in a row altogether. And then, the audience is, cheering for her, all that. And then everybody sat down and she sat down. And what I said to the room was, if the universe is big enough, and we talked about in the last episode about thousands and thousands and thousands of mutual funds that have been opened and closed. Over 60,000 have been opened altogether. It is merely a matter of random chance and statistical probability that there would be something like the Fidelity Magellan Fund. This is nothing against that particular fund, but you'll watch these asset managers have an amazing streak, and then they slowly fall apart. And having had a chance to interview somebody on the inside of one of these large mutual fund companies who was a partner in that firm, and he said, this is off the record, which is why I'm not disclosing anybody's name, but he said it was amazing. I explained this concept to him, and I said, now that you understand this concept, let me ask, as the mutual fund's performances were waning, what did the asset management team say? And the guy said, they had all kinds of reasons. Because trading had happened in the marketplace differently, or because the flash traders were in the market, or because they now had more assets than they'd had in the past. They weren't able to buy and sell as efficiently. All that, and all that can be true. But at the end of the day, even their prior success can be attributed to nearly random chance in the fact that people are just trying to beat the market in a way that is not likely that they're going to be able to do so. And we wonder why, literally on every single statement you have from any investment company, it says past performance is no guarantee of future results. And the reason it says that is because it's true. In fact, Stefan Sharkansky, who is upcoming on our podcast here, he has got some amazing feedback and research report that says not only is past performance no guarantee of future performance, they're not even lightly correlated, meaning that these active managers don't have the ability to outperform the market. And even if they outperform the market, it's unpredictable, and it's unpredictable that they could have any kind of repeat performance. You see, what we want for all of you as you're listening is to just be able to think through and not follow the rock star asset managers. As we get later in this series, we're going to talk about portfolio building and literally give you some tools that you can execute with. But when it's all said and done, all of the asset managers that have a quote unquote good story about their performance are not likely to be able to repeat that performance. And yet, when are you likely to be attracted into an investment like that? Is after they've already had the performance, the very time they're least likely to repeat that performance. So I hope you guys have enjoyed this episode today. And as always, from Cory, myself, everybody at Sound Financial Group, we hope that this episode of Your Business, Your Wealth has been a contribution to you being able to design and build a good life. Hey everyone, thanks for watching. Be sure to subscribe, ring that bell, and when you get a moment, pick up my book on Amazon, Sound Financial Advice. It's the kind of book that's easy to read, but hard to forget all the knowledge you learned.